Welcome back to the deep dive. We have an absolutely massive one for you today. We are looking at money, but, not just looking at the charts.
Wow.
We're looking at money through the lens of physics, the lens of survival, and honestly, through the lens of how to live a good life. But before we get into all the heavy philosophy and the hard numbers, we actually have a tool to share with you right off the bat.
We do, and it's a really useful one. If you're trying to navigate these choppy waters, you really need a compass. To track total market temperature, welcome to search and download the iOS app Buffett Indicator from the Apple App Store.
And for our global listeners who might want to get that in its native language,
Apple Store searches Apple Store he.
Okay, let's unpack this. Today isn't just another how to pick stocks show.
Not at all.
We are diving into a transcript of a conversation that, frankly, it kind of blew my mind a little bit. It's between the economist Wang Qingyu and a man named Chang Jin.
And Chang Jing is a name you might not see in the headlines every day, but in the world of high-stakes capital allocation, he is a very serious player. He's a core partner at Himalaya Capital.
And for context, Himalaya Capital was founded by Li Lu.
Right. Li Lu is, he's legendary. He's widely considered the primary inheritor of the Charlie Munger and Warren Buffett philosophy, especially in the Asian markets.
Wow.
Think about it. He's the only person Charlie Munger ever gave his own family money to invest. So when Chang Jing speaks, he's speaking from that direct lineage.
That's some serious validation.
It is, but what makes Chang so fascinating is that he isn't your typical finance bro. He didn't come up just crunching Excel sheets.
No, his background is in atmospheric physics.
Exactly.
Which, that sounds like he should be predicting hurricanes, not market crashes. But I think as we go through this, we're going to see that those two things are actually pretty similar.
They're both complex, chaotic systems. But Chang is incredibly modest about it all. Throughout the source material, he keeps referring to himself as merely an assistant to Li Lu.
An assistant?
Yeah, but the insights he drops here, they bridge the gap between hard science, gritty entrepreneurship, he's a salesman, which we have to get to, and, managing billions of dollars.
So the mission for this deep dive is really specific. We want to deconstruct the gap between knowing something and actually doing it. Because, and I think you'll agree with me here, the concepts of value investing are, well, they're simple.
Oh, they're deceptively simple. Buy low, sell high, keep a margin of safety.
Don't lose money.
Right. You can teach a 10-year-old the rules of value investing in an afternoon.
But actually doing them?
Doing them when the market is melting down or when, everyone around you is getting rich on some bubble, that is excruciatingly hard. It really requires a rewiring of your entire psychology. And that is what Chang Jing focuses on.
So let's jump right into that, into the core philosophy. He starts with a word that we teach toddlers, but he applies it to hedge funds. Honesty.
But he's not talking about, don't tell a lie. He's talking about intellectual honesty. It is a rigorous, almost painful standard. And he uses this analogy that I think perfectly captures the human condition.
Which one is that?
The penny versus the $1,000,000 test.
Okay, I want to dig into this because on the surface, it sounds simple. But walk me through the psychology here.
Okay, so imagine you're walking down the street. It's broad daylight. You see a penny on the sidewalk, or hey, maybe it's a $10 bill. What do you do?
If it's a penny, I'll probably just leave it. If it's $10, I might look around, ask, did anyone drop this? It's low stakes. I'm a good citizen.
Exactly. Most people are honest when the stakes are low and the social pressure is high. But Chang flips the script. He asks, what if you're walking down a dark alley in the middle of the night?
Okay.
No security cameras, no witnesses, and you stumble upon a black bag filled with $1 million in cash.
That is a very different scenario.
The test is, do you take it? And more importantly, if you take it, do you admit to yourself why you took it?
Well, obviously taking it is theft. But in the investing world, finding a bag of money isn't a crime. So how does this apply to buying stocks?
This is the crucial link. In the market, the dark alley is complexity. And the bag of money is a hot stock or a trend that you don't actually understand, but it's making everyone else rich.
Okay.
Let's say there's a new crypto token or an AI startup that has, tripled in value in a week.
Right. And I'm looking at it and I'm thinking, I need to get in on this. I've got that FOMO.
The temptation is to grab that bag of money.
Right.
But here is where the dishonesty kicks in. You don't just grab and say, I'm gambling.
No?
Your brain creates a narrative to protect your ego.
Yeah.
You tell yourself, oh, I've read a few articles about blockchain. I get it. I understand the paradigm shift. I'm investing based on fundamentals.
So I'm lying to myself to justify the greed.
Precisely. You are convincing yourself that you found the money because you're smart, not because you're lucky or just reckless. Chang argues that this lack of intellectual honesty, This inability to just say, I don't know, when the money's on the table, is the #1 killer of wealth.
Because eventually the owner of that bag comes looking for it.
Or, in market terms, reality catches up. If you bought something because you pretended to know the future, but you're actually just guessing, Mr. Market will eventually find the flaw in your logic. And when the bubble bursts, because you didn't actually understand what you bought, you won't know when to sell. You'll be left holding the bag when it's empty.
So I don't know, isn't just modesty, it's actually a survival shield.
It is the highest form of risk management. Chang talks about his early days as a management consultant. He was young, fresh out of school, but he was charging these huge fees to tell veteran CEOs how to run their businesses.
Right.
He admits he had to pretend to know things. In consulting, you can kind of get away with that. You make a PowerPoint, you get paid, you leave.
Fake it till you make it.
But in investing, the feedback loop is brutal and absolute. If you fake it, you lose your capital. The market does not care about your PowerPoint presentation.
This bleeds right into the next pillar, which is the safety margin. Now, I've heard this term 1,000 times, margin of safety. It's usually described as buying a dollar for 50 cents.
And that's the financial definition. But Chang, he expands it into a life philosophy. He uses this great analogy about getting to class or a meeting.
The 9:00 a.m. rule.
Right. If you have a class at 9 a.m., do you plan to arrive exactly at 9:00?
Well, if I'm being efficient, I plan for 9:00. Why waste time sitting in the hallway?
But that efficiency is fragile. If you plan for 9:00 and you hit one unexpected red light, or you can't find your keys, or the elevator is slow, you're late. You failed. The whole system breaks.
So Chang suggests aiming for 8.50.
Aim for 850. Build in a buffer, a cushion. Now, apply this to a business. Many modern businesses are obsessed with optimization.
Oh, yeah. Lean manufacturing, just in time.
Just-in-time supply chains, maxed out leverage, running at 100% capacity to squeeze out the highest possible profit margin.
That sounds like good management, though.
It sounds like it, until something goes wrong. If a business needs perfect execution just to be profitable, it has no safety margin. Chang says true value lies in a business that can have a screw-up.
Okay.
It can have a factory fire, a bad product launch, a recession, and still survive.
It's like engineering a bridge. You don't build a bridge to hold exactly the weight of the cars you expect. You build it to hold 5 times the weight.
Exactly. But here is the catch, and this is why it's so hard psychologically. Aiming for 8.50 feels inefficient. Building a stronger bridge costs more money. And in finance, holding cash, which is the ultimate safety margin, feels like losing.
Right. If I'm holding 20% of my portfolio in cash to be safe and the market goes up 20%, I feel like an idiot. I missed out. I left money on the table.
That is the pain of the safety margin. You have to be willing to look stupid and feel inefficient in the short term to ensure you survive the long term. Chang says if you can do 100% effort, promise 80%, leave room for the unexpected. That gap isn't waste. It's your peace of mind.
I love that. The inefficiency is the price of survival. But let's play devil's advocate. Chang talks about speculation versus investing. He admits you can make money speculating.
He does. He's not dogmatic about it. He brings up James Simons of Renaissance Technologies.
The quant king, the man who cracked the code.
The quant king. Simons and his team used massive computing power and, these complex algorithms to speculate on short-term price movements. They made billions. Chang acknowledges this. He says, yes, speculation works if you are James Simons.
But I am not James Simons.
And neither are 99.99% of professional fund managers. Chang's point is that speculation is a zero-sum game. It's a poker table. For you to win $1, someone else has to lose $1.
And if you're sitting at the table with Renaissance Technologies,
you're the patty. You're the leek, the jukai, the sucker waiting to be harvested. Chang argues that unless you have a supernatural talent for math and better data than everyone else, speculation is just a slow way to give your money to people like James Simons.
Whereas value investing is positive sum, is that the idea?
That's the argument. If you buy a piece of a company that actually creates value, makes cars, sells food, provides healthcare, and that company grows, the pie gets bigger. You win, the employees win, the customers win. You aren't winning because someone else lost. You're winning because the world got richer.
Okay, so if we accept that we need to be honest, we need a buffer, and we shouldn't gamble, how do we actually pick the winners? Chang gives us a framework, a sort of matrix for evaluation.
He breaks it down into strategic, financial, and operational layers. The financial stuff is what you'd expect. High return on equity or ROE, strong cash flow, low debt. He specifically looks for companies that distribute more dividends than they raise in capital.
A cash cow, not a cash incinerator.
You got it. But the part that I found most interesting, and honestly the most fun, is the subjective stuff. He calls it the restroom test.
Okay, I have to stop you there. This sounds like investor folklore. Are you seriously telling me that a multi-billion-dollar investment decision hinges on whether the janitor cleaned the stalls that morning? I mean, isn't that a bit trivial?
It sounds trivial, doesn't it? It sounds like something a quirky uncle would say at Thanksgiving.
Yeah.
But Chang insists it's a rigorous data point. Think about entropy.
Disorder. Things falling apart.
The natural state of the universe is disorder. Things fall apart. Dust collects. Systems break down. To keep a factory restroom clean, really clean in a facility with 5,000 workers requires a relentless, almost obsessive system of management discipline.
So it's not about the toilet, it's about the discipline.
It's entirely about the discipline. Chang says when you visit a company, you can feel the key field, the atmosphere. Look at the workers. Are they focused? Are they relaxed? Are they stressed and chaotic? And then check the restroom. If the lobby is all marble and gold to impress the investors.
Yeah.
But the employee restroom is filthy. It tells you something very profound about the culture.
It tells you they cut corners when they think no one is looking.
And if they cut corners on hygiene, Chang argues they will eventually cut corners on product quality or safety standards or, worst of all, financial reporting.
That connects right back to the penny versus $1 million thing. It's about character.
It is. He quotes Duan Yangping, another investing giant, who says, "A company can make strategic mistakes, but it can't make mistakes on quality or culture. You can fix a bad marketing campaign. You can't fix a rotten culture."
So next time I visit a headquarters, I'm skipping the boardroom and going straight to the stalls.
It might be the most valuable due diligence you do.
But beyond the bathrooms, there's this concept of the circle of competence. We hear this all the time. Stay in your circle, but how do you know where the circle ends? I think most of us, our ego tells us our circle is bigger than it actually is.
That is the Dunning-Kruger effect in a nutshell. We all think we're experts. Chang gives two brutal tests to see if you are actually in your circle. The first is what he calls the conversation test.
Okay, how does that work?
He asks, can you talk to an industry expert, a real veteran in the field, and tell them something they didn't know? Or can you point out a blind spot in their thinking?
That is a wildly high bar. I mean, if I'm talking to the CEO of a biotech company, I'm usually just nodding and trying to understand the big words they're using.
If you're just nodding, you're not in your circle. You're a tourist. But if you can say, actually, looking at the phase 2 data from your competitor in Germany, their efficacy rate suggests your target market might be smaller than you think, and the CEO pauses and says, I didn't consider that, then you're in the circle.
Okay, that rules out about 99% of the stocks I've ever looked at. What's the second test?
The ownership test. This goes back to the difference between, say, renting a stock and owning a business. If you own a restaurant, what do you worry about?
I worry about the price of tomatoes. I worry if the chef is happy. I worry if customers are coming back on Tuesday nights.
Right. Do you worry about what someone is willing to pay for your restaurant every 10 seconds?
No, of course not. I'm not trying to sell it every 10 seconds.
Chan says if you find yourself obsessing over the stock ticker, oh no, it's down 2% today. Oh wait, it's up 3%. You don't understand the business. You're treating it like a gambling chip. If you truly understand the value, the price fluctuation is either irrelevant noise or, even better, an opportunity.
He gave a great example of this true understanding involving Apple. And this answers a question we got from a lot of listeners regarding Duan Yangping.
Yes, the large screen prediction.
Right. Years ago, Apple refused to make big phones. Steve Jobs famously said, no one wants a big phone. You can't reach the corner with your thumb. But Duan Yangping was buying Apple aggressively, predicting they would make a big phone.
And he was right. But the question is, why was he right? He wasn't an insider. He didn't have a spy in Cupertino. He just understood the consumer. He knew that people were using phones for video and games, not just calling. He knew the demand for more screen real estate was irresistible.
So he understood the business logic better than the management did at the time.
Exactly. He knew that Apple was, at its core, a rational company. And eventually, rationality would win out over dogma. That is deep competence. He wasn't betting on a rumor. He was betting on human nature and fundamental business logic.
So let's say we do all this work. We check the bathrooms, we pass the conversation test, we buy the stock, and then the market crashes. Everything goes down.
Which brings us to the hardest part of the equation, handling volatility.
Chang talks about this in the context of opportunity cost, which he notes is a concept Chinese investors often ignore.
It's a fascinating cultural observation he makes. He says in fast-growing markets like China, historically, people just looked at absolute return. I put in 100, I got back 120, I won.
Seems logical.
But sophisticated capital asks a different question. What else could I have done with that 100?
Right. If the market index went up 40% and you only made 20%, you actually lost.
Exactly. You destroyed value relative to the passive opportunity. For a fund manager, their opportunity cost is the benchmark index, like the S&P 500. If you can't beat the index over time, you shouldn't exist. You should just give the money back.
This concept perfectly explains the divergence we saw recently with Apple and BYD. Why did Warren Buffett sell some Apple while Duan Yongping kept it? And why did Buffett sell some BYD while Himalaya Capital Chang's firm held on to it?
It's not that one guru is smart and the other is dumb. It's that their opportunity costs and their safety margins are different. Take Buffett. He's managing hundreds of billions. He has a massive cash pile.
Right.
When Apple's valuation got sky high, his safety margin shrank. For him, moving that money into treasury bills, earning 5% risk-free, might have been a better risk-adjusted bet than holding an expensive stock.
He has a different menu of options than the rest of us do.
Exactly. But let's look at Himalaya and BYD. This is the case study that really blew me away.
Yeah.
We need to spend a minute here because it captures the sheer agony and the conviction required for value investing.
Okay, so they bought BYD in 2002.
2002, before EVs were cool, before Tesla was a household name. And since 2002, Chang notes that BYD's stock price has dropped by more than 50%.
Wow.
6 separate times.
6 times.
Not once, 6 separate times.
You just sit with that for a second. Imagine you put $1 million into BYD. It goes up, you feel like a genius. Then it crashes to $500,000. You feel sick, you hold, it goes back up. Then it crashes again.
Most investors, even professional fund managers, would vomit and sell after the second drop. They would say, this is too volatile, I can't take it, my clients will fire me.
So why did Himalaya hold? I mean, are they masochists?
No, they were looking at the business, not the ticker. Chang mentions a specific crisis. He calls it the dealer revolt.
What happened there?
At one point, BYD pushed their sales targets way too hard. The dealership network just collapsed. Dealers were quitting, suing. It was a total mess. Sales tanked. The stock tanked with it. The narrative in the media was, BYD is done.
That sounds like a perfectly valid reason to sell. The business is failing.
It does. But Himalaya watched the management. They asked the crucial question, are they in denial? And the answer was no. The management admitted the mistake. They spent 3 painful years fixing the dealer network, apologizing, restructuring. They showed they could learn from their mistakes and solve huge problems.
So the volatility was a stress test of their character and competence.
Precisely. Chang says if a company can make a catastrophic mistake, fix it, and come out stronger on the other side, that is the ultimate buy signal.
Yeah.
But you only see that if you have the iron stomach to ignore the stock price falling 50% while they're in the middle of fixing it.
That is the difference between renting a stock and owning a business. If your house has a leak, you fix the leak. You don't sell the whole house for half price.
Exactly.
Yeah.
But sometimes, and this is crucial, a drop is just a drop. Sometimes the house is termite infested and it is going to collapse. Chang shared a story about a value trap that I think is really important. We don't hear investors talk about their losses enough.
This was the failure story to show they're not perfect.
Yes, they invested in a company that looked perfect on paper. Low PE ratio, profitable, simple business model. It was statistically cheap.
So what went wrong? What did they miss?
They missed the governance risk. The major shareholder, the guy running the show, was a crook. Not technically maybe, but ethically. He was using the company's cash to do merger and acquisition deals. He would buy other companies at inflated prices.
Let me guess. He was buying companies that he secretly owned, or his family owned.
Or that his friends owned. He was siphoning the shareholders' money into his own pockets through these crooked M&A deals.
That is straight-up theft disguised as corporate strategy.
It is. And Chang admits they missed it because they were looking at the cheap stock price and got greedy. They didn't scrutinize the character of the owner enough.
The lesson being, cheapness is not a safety margin if your partner is dishonest.
Exactly. A cheap price cannot compensate for bad character. If the management doesn't have a fiduciary duty mindset, if they don't treat the company's money like it's your money, you're just the turkey at their Thanksgiving dinner.
Okay, I want to pivot. We've talked history, we've talked philosophy. Let's talk about right now. You cannot have a conversation like this in 2026 without talking about AI.
The artificial intelligence revolution. It's the only thing anyone is talking about.
Chang compares it to the Industrial Revolution. You know, steam engines replace muscle. AI replaces brain power. He thinks it's inevitable.
He does. He's a believer in the technology. However, he is terrified of the current stock valuations.
He used an analogy that I think every listener needs to hear, especially if they are holding NVIDIA or these massive chip stocks. He called it the solar panel analogy.
This is a warning about what he calls technological deflation.
Break that down. What does that mean?
Okay, think back to, say, 2010. Solar energy was the future. Everyone knew it, and they were right. Solar is everywhere now. It's cheap, it's efficient. The technology won.
So the investors must have gotten rich.
No, most of the solar manufacturing investors got wiped out, annihilated.
How is that possible? If the technology won, why did the investors lose?
Because the technology improved too fast. If you built a solar panel factory in 2010, you spent say, $100 million on equipment, and your panels cost $2 per watt to make.
Okay, makes sense.
But 2 years later, a new technology comes out. Now new panels only cost $1 per watt to make. Your factory is now obsolete. Your $100 million investment is worthless because you can't compete with the new guys who have the better tech.
Your asset became a liability overnight.
Exactly. It's CapEx destruction, capital expenditure destruction. And Chang worries this is exactly what's happening with AI right now.
With the GPU chips.
Right. Companies are spending hundreds of billions of dollars buying H100 chips right now.
Yeah.
A massive gold rush. But NVIDIA is releasing a new chip every year that is 2 or 3 times faster and more efficient.
So if I spend $1 billion on chips today,
In 2 years, those chips are basically junk. They're electronic waste because the electricity cost to run them is higher than the value they produce compared to the newer, more efficient chips.
that is a terrifying thought. So all this investment we see on the balance sheets of big tech might actually be a future write-off.
It might be. Unless, and this is the key, unless they find a killer app right now that generates enough cash flow to pay for those chips before they become obsolete.
And currently, are they? Is there a killer app?
Chang argues, not really. Not yet. Right now, it's a lot of B2B selling. One company sells chips to a cloud provider who sells compute power to a startup who uses the compute to, well, mostly to make demos or chatbots that aren't making massive consumer profits yet.
It's a game of hot potato with capital.
He calls it a potential Ponzi game. Not in the criminal sense, but in the structural sense. Money is circulating between all these infrastructure players, but there isn't enough real consumer revenue coming in at the bottom to justify the trillions in spending atop.
That is a very sobering reality check. Just because the technology changes the world doesn't mean the first movers make money. Railroads changed the world, but most railroad stocks went to zero.
Exactly the same principle.
Let's zoom out even further, macro. Chang talks a lot about China, and let's be honest, the mood on the Chinese economy lately has been gloomy.
Gloomy is putting it mildly. You hear about the real estate crisis, export slowdowns, youth unemployment. It sounds dire. But Chang takes a very contrarian long-term view. He's actually optimistic.
Why? I mean, what is he seeing that everyone else is missing?
He looks at the structural transition. He says China is moving from an investment and export-led economy to a service and consumption-led economy. And he explains why this is inevitable using a really smart observation about efficiency.
The robot versus the doctor.
Right. Think about manufacturing. What is the ultimate goal of a car factory?
To make cars as fast and as cheap as possible, with as few defects as possible.
Exactly. To increase efficiency.
Yeah.
And how do you do that? You use robots. You remove humans. Manufacturing, by its very definition, tries to reduce the amount of labor needed per unit of output. It destroys jobs to create goods.
Okay, I follow that.
But the service industry, things like healthcare, elderly care, entertainment, education, design, it's different. The value is the human. You don't want a robot doctor to rush you out in 30 seconds. You don't want a highly efficient concert that lasts only 5 minutes.
The value comes from the human time and the connection.
Exactly. So Chang argues that the service industry is the only sector that can sustainably absorb the workforce and create real income growth. You can't robot your way to a thriving middle class. As China gets richer, the money must flow into services.
So the transition we're seeing now is painful, but the destination is a high-income service economy.
That's his thesis. But to invest in China, you also have to understand the government, the policy cycles.
Oh, the stroke of a pen risk. We've seen entire industries like for-profit tutoring or internet platforms get crushed overnight by a new regulation.
Chang views this differently. He sees the market as a complex adaptive system. Remember, he's a physicist. He said the government is just part of that system. It acts in cycles. When a sector overheats or causes social instability, the government intervenes.
So it's a reaction, not a random attack.
Right. And he views these crackdowns as stress tests. If a company like Tencent or New Oriental can get hit by a massive policy hammer, survive, adapt, and come out the other side, they are anti-fragile. They are buys.
You price in the policy risk, you don't run from it.
Exactly. Which, brings us back to his roots, to physics.
I promise we'd get back to this. Life as an algorithm.
Chang views the market as being much harder than weather prediction because clouds don't have emotions. A storm doesn't decide to change its path just because you bought an umbrella.
Right, but the market does. If I buy a stock, my action changes the system, even if just a tiny bit.
It's reflexive. The act of observation changes the outcome. So Chang uses the scientific method. Hypothesis, data, test, revise. He says you must never, ever assume a static state.
And this leads to my favorite story in the whole transcript, the cold calling story. Because it really humanizes him. He wasn't born a guru.
No, not at all. He was a terrified 20-something in Silicon Valley back in the 90s. He was trying to sell computer memory chips during a downturn. And he was an introvert.
I think anyone who has ever done sales knows that feeling. Just staring at the phone, dreading the rejection.
He failed for 2 weeks straight. 0 sales. He was about to quit. But then the physicist's brain kicked in. He realized, I can't out-talk these Americans. I'm not a schmoozer, but I can outthink them.
He went to the data.
He built a database of all the potential clients. He categorized them. But more importantly, he went to the library. He read every computer magazine he could find, PC World, Byte magazine. He memorized the specs of every motherboard and every new chip.
He became a walking encyclopedia of computer hardware.
So when he called a client, he didn't say, please buy my chips. He said, hey, I see you're using this particular motherboard. Did you know that the memory chip you're ordering actually has a compatibility issue? You should be using this other one instead.
He flipped the entire dynamic. He wasn't a beggar. He was a consultant. He was helping them.
He was adding value.
Yeah.
And suddenly, he wasn't selling. He was advising. He became the top salesman in the company.
And that connects all the way back to the beginning. Honesty.
Yes.
He could have lied. He could have just pushed whatever product had the highest commission. That would have been the $1 million in the dark alley move.
Exactly. But he chose the hard path, the path of competence and truth. And that is what built the trust that made him successful.
So bringing this all home.
Yeah.
Why do this? Why stress about safety margins and dirty restrooms and dealer revolts?
Chang says value investing is ultimately a framework for a happy life.
A happy life. That's a big promise for a financial strategy.
But think about the components we've discussed. If you are intellectually honest with yourself, you don't have to carry the weight of lies or imposter syndrome. If you have a safety margin in your life, you don't live in constant fear of the unexpected.
You sleep well at night.
You sleep well at night. And if you focus on your circle of competence, you do work that you actually understand and enjoy. You aren't chasing someone else's dream or getting swept up in a trend you don't believe in.
And you aren't jealous of the speculator making fast money next to you because you understand the risks they're taking and you've chosen not to play that game.
Chang concludes that wealth is just a byproduct. If you run this algorithm correctly, honesty, safety, competence, the money tends to show up over time. But the real asset you gain is peace of mind.
That is a beautiful place to land. From the gritty details of a factory floor to the algorithm of happiness.
It really is a complete worldview.
So, to recap our journey today, we started with the penny versus the $1 million test, the brutal need for intellectual honesty. We looked at the safety margin, not just as a number, but as the willingness to be inefficient to survive. We did the restroom test for culture. We analyzed the gut-wrenching volatility of BYD and the potential solar panel trap of the current AI bubble.
And finally, we saw how a terrified physicist used data and honesty to become a master salesman and ultimately a master investor.
It's a masterclass. So before we sign off, what is the final provocative thought for our listeners to take away?
Well, connecting this to the bigger picture, Chang mentioned a profound idea. Knowledge is knowing what you know. Wisdom is knowing what you don't know.
Right.
We live in the age of AI. Information is infinite. ChatGPT can give you an answer to anything in seconds. In a world where answers are cheap and abundant, perhaps the ultimate competitive advantage for you, the listener, is simply being the person who can stand up and say, I don't know.
Because I don't know is the start of real inquiry. It's the beginning of wisdom.
Exactly. I don't know keeps you safe from the bubble. I don't know makes you curious. And I don't know allows you to wait patiently for the fat pitch. The opportunity that is so obvious, so clearly in your circle of competence, you don't need to guess. In an algorithmic world, humility might be the ultimate algorithm.
That is definitely something to chew on. All right, before we go, we need to handle the official business.
Indeed.
Yeah.
Disclaimer. All analysis is based on publicly available sources and may be subject to revisions or differing interpretations. The content is for educational purposes only and does not constitute investment advice. Conduct your own due diligence before making investment decisions.
And for those of you who want to go even deeper with us on topics like this,
if you want to listen to our full deep dive about this topic or access more advanced contents, welcome to join the Deep Value Club membership or subscribe to us on Apple and Spotify podcasts channel, Deep Value Investing, and luluvc.com.
And for our bilingual friends out there,
挑玩也是玩。小king其实讲呢，给你玩法，是开始有bon，是你把弄生意了，是有玩色养文毛无聊呢，是有些先生大有。这个钱晚上乱的，现自己是问，是才生意哦，温波盘下，这才星期一问，是现经济薪资晚点，省是2万我波，正怕上波出来。正常是生做摩托当时波身上生文，这是袜子的不加是文字的是生福利港不啦。这真是让是真生为黄真生高， 生是活动，我过去有的个文化旁。搿生是往是保持总是生到说生啊是咱这生是放生说生多保生是往生是不总生。生数是呢？这出生啥是说了生呢？这是真是呢是真数主啊，是在是吧？是往是让我我的不是